Alright, so it's 11:15 and we'll start our webinar now. So today we have Singapore Banking Monthly, US Weekly, Clearbridge Health Limited Initiation, and our Phillip Singapore Weekly. So we'll start off with the Singapore Banking Monthly. So for Singapore banking sector, the February domestic loan growth was rather flat at 3.3% year-on-year in comparison to January's 3.2% year-on-year. And you can see from the graph here, the dark blue line is our business loans and the red line is our consumer loans. So our consumer loans has been decelerating much faster than our business loans. And the light blue line is our overall Singapore loans. So our consumer loans, it has been decreasing because it's being dampened by our mortgage growth of only 1.2% year-on-year in February. And this is the 10th consecutive contraction for the mortgage growth since peaking in May 2018 over here. So for the business loan side, it's being held up by our building and construction loan. It grew 12.7% year-on-year in February, and this is rather high as compared to a monthly average of only 4.9% year-on-year in 2018. So moving on to deposits, our February deposits grew 6.3% year-on-year, and this is the fastest in 2 years. So from the chart here, you can see the red line, which is our fixed deposit growth. It's spiked up since February 18, around early 2018 to around 18.9% year-on-year in February. So this is very high, very huge surge in growth as compared to our FY18's monthly average of only 1.6% year-on-year. So this surge in fixed deposit is attributable to the rising interest rates, and banks are accumulating deposits in anticipation of higher interest rates and to reprice them as loans. And for CASA, the light blue line here, it contracted 1% year-on-year. So from the chart here, you can see that fixed D is increasing while CASA is decreasing. And this poses as an issue for the banks because the cost of funds is likely to increase along with the higher proportion of fixed deposits. So the proportion of fixed deposit and CASA as of February, it's around 41% for CASA and 41% for fixed D and 59% for CASA. Moving on to interest rates, our March 3-month SIBOR is at 1.944%, and this is 0.8 basis points below last month's 11-year high of 1.953%. So this is SIBOR is rather flat. The decrease is marginal. Whereas for SOR, 3-month SOR fell 8 basis points month-on-month to 1.933. So despite the dovish tone set by the US Federal Reserve, we expect the banks to continue to deliver net interest margin improvement in the upcoming results in May. So this is due to the time lag for the rate hikes to pass through into our Singapore's SIBOR and SOR. However, even though we expect net interest margin improvement, we do not expect interest rates to rise as fast as it did in 2018. And margins could also be threatened by the costlier funding that we saw earlier due to the rise in fixed deposit, the surge in fixed D. And this is the costlier amount of funding as compared to CASA. So as interest rates rise in the region, such as HIBOR as well, the cost of funds for the banks will rise as well. So in Hong Kong, 3-month SIBOR fell 57 basis points year to date after peaking in December 2018 at 2.327%. So for our investment actions for the Singapore banking sector, we still maintain the Singapore banking sector at overweight at this moment because we expect further upside in net interest margin improvement from the full impact of loan repricing, as well as lower provisions this year. Low provisions maintained this year, although it will be higher than 2018's extreme lows. And also better cost management should also help provide upsides to ROE improvement for the banks. And the banking sector has an attractive dividend yield support of around 5%. And all three banks' CET1 ratio right now is at similar levels. Previously, UOB's CET1 ratio is much higher than DBS and OCBC, but as of FY18, they are all on par right now. And their strong, robust CET1 ratio should sustain current payout ratios. So the key risk to the banking sector will be lower pass-through of interest rates into SIBOR and SOR, and margins threatened by costlier cost of funds as interest rates rise, and market volatility to continue to pressure your treasury markets revenue, your trading revenues, your investment banking downwards. And cost to income ratio to be weakened by investment costs by the banks into technological ventures. So this is just for me to highlight the new Ezion and Yinson deal. So basically for this deal, there's a two-part agreement. The first one is the debt conversion and subscription of shares. So Yinson agreed to take on the 916 million debt that you can see here. Previously, before the deal, the debt for Ezion is around 1.4 billion. And after the deal, if we minus away 916 million, their debt will be 491 million. And the deal is that Yinson will take on this 960 million debt, and in return, Ezion will give Yinson shares. So the number of shares after the deal will increase to around 26 billion. And for the option side of the agreement is the option gives the right to Yinson to subscribe for 1 year ordinary shares in Ezion at the option price of I think was 6.5 cents. So based on that, the total options available will be around 3.4 billion to be granted to Yinson if they want to exercise it in the future. And the impact on Yinson is that upon completion of the subscription of shares from Ezion, their interest in Ezion will stand at around 85.9%. And Ezion's enlarged share capital will increase nearly 8-fold. And the shareholding could go up to a further 87.5% for Yinson if they were to exercise this share option over here, the second part of the agreement. And the debt servicing agreement is still in progress between Yinson and the lenders. So the Yinson is going to put in a cash outlay of around 200 million to repay the 960 million debt, along with an additional Ezion shares to go with it. So the amount of cash and shares is still in negotiation with the lenders, and the major lenders of Ezion is DBS, OCBC, UOB, Maybank, CIMB, and Caterpillar Financial. So DBS and OCBC is Ezion's largest bank lenders. So put everything into color and a better view. This is the results of the banks for FY18 actual results and our FY19 forecasted. So for the total debt of 916, 200 million is being repaid in cash by Yinson. And the haircut taken by the lenders is around 80%. So if you were to look at the bank's provisions made in the previous year, the 700 million haircut is quite substantial if you look at it this way. But given the new IFRS accounting standard, it requires the banks to make progressive provisioning as they assess the credit quality of the debt. So in FY18's provisioning that you see here, there's probably already some provisioning already provided for Ezion's credit quality deteriorated in FY18. So this is just to highlight to you the potential impact to be expected in our upcoming banking results regarding Ezion's haircut for the debt. So moving on to Edmund, he will talk to you more about US Weekly.
All right, thank you, Min. So for the US macro last week, the retail sales month-over-month fell slightly, but the headline sales were boosted by the price-related 1% increase in gas station sales. However, there was a big drag from the 4.4% plunge in the building material sales. There's a modest rebound in the ISM manufacturing index to 55.3, which beat the estimates of 54.6 in March, which is mainly driven by the new orders and employment components. As for the non-manufacturing index, it dropped to a 20-month low of 56.1, which is driven by sharp declines in the business activity and new orders. So we can see that currently GDP growth is slowing for the US, but a positive news is that non-farm payroll increased more than expected in February, and unemployment rate was unchanged at 3.8%. In terms of the corporate news, Tesla's shares dropped more than 10% because it failed to meet its estimates on the number of units delivered. So in Q1 2019, it delivered only 63,000 units, which is nearly a third fewer than the 90,000 achieved in Q4 2018. So they mentioned that the push to start the Model 3 electric sedan deliveries to China and Europe was not going as well. But despite the poor sales, they maintained their guidance of 360,000 to 400,000 vehicle deliveries in 2019. However, because this is Tesla, we know that there are many instances where they have failed to meet the guidance. So for the week ahead, some of the key indicators to be released will be the core inflation rate, the Fed power speech, and the University of Michigan's Consumer Sentiment Index. This is a list of the upcoming earnings. So as I mentioned last week, during mid-April, there will be a lot of banks who are releasing their results. And so right now, I'll pass on my time to Paul to talk more about Clearbridge.
Okay, thanks. Thanks, Edmund. We'll move on to Clearbridge Health Limited, our initiation. We initiate coverage with a buy at target price of 28. Do note at the bottom that this report is produced under the SGX Top Facts Research Program, whereby we actually receive monetary compensation for the production of this report. I'll move on just to give a bit background on Clearbridge Health. They listed in late 2017 at 28 cents. When they listed, there were only two medical clinics, two GPs in a way, and also one lab in Singapore. So it was very small. But since then, what they've done, and as per their business model, is that they'll be making a whole slew of acquisitions. And the most attractive ones will be those that in Philippines and also in Indonesia. I'll elaborate later. Most recently, only just last week, they completed acquisition of a lab chain in Indonesia called IGM. Okay, I'll move on. Okay, because there are multiple parts of the business, so I'll just focus on the key ones. So the biggest one would be what's happening in Indonesia. So in Indonesia, they've got this company called TMJ. So they do renal dialysis, basically just kidney dialysis. So what happens is that they have a kidney dialysis center in 21 hospitals in Indonesia. With another, they've got contracts for actually 34. So this will provide growth for them. The attractiveness of this business is because it's recurrent. These dialysis machines are located inside the hospitals. And as you know, regretfully, most of these patients need to do dialysis a couple of times a week. How they make money is that the patients pay a fixed fee and normally is covered by the national insurance. But there are two revenue models. They can either get they do a revenue split with the hospitals, or they can just sell the consumables at the hospitals. Most of the machines that you see in the kidney dialysis is all provided by the equipment vendor. What the vendor wants to make is the usual. They just want to sell the consumables and not so much the equipment. Okay, the other business which they just acquired for 89% stake is actually a lab in business in Indonesia. What's attractive about this lab is that, of course, it's 12, and the lab actually resides inside the hospitals. So as you know, once you're inside the hospital, any requirements for tests and so forth, you've got a captive pool of patients, because the hospital obviously won't go outside, since most of the lab services can be done in-house inside the hospitals. So in terms of the growth, sorry, I missed one word. They're actually looking to expand this into more hospitals, and also to sell more higher-end lab services, which I'll elaborate later, into these hospitals. The other attractive business, the third one, is the medical center they have in Philippines. I think they acquired it in 2018, But what they've done is they did some major renovation, and then and also they've introduced new services to this. So both of these factors will be contributing to the growth for these hospitals. They were selling more pharmaceutical products, and they actually introduced again a renal care, which is kidney dialysis, and also they opened up 3 aesthetic centers in Philippines. So not only have they acquired this, they actually refurbished and revitalized the whole center. The third business, these are all in Singapore. It's the original lab that they acquired, which is part of the IPO. So the way to grow this business is not the usual health screening and so forth. You need to, because the patient load for such business is probably low single digit. What you need to do is actually the uplift in revenue or margins will come if you can sell more esoteric or more higher value add tests. For instance, just an example, what they can do is maybe they will represent this company called Cell Search. For example, there are many other names, but one of this will be, let's say, Cell Search. So they will be the distributor for this test. They could actually go to various countries, even in Malaysia, and sell these very high-end tests, which they could actually even be the exclusive distributor. So they could actually sell like a cancer marker test to some of these other customers or doctors or oncologists in other countries like Malaysia and so forth, or Singapore. And once they use this test, they can actually charge higher and gain higher margins. The other business they had is they acquired this aesthetic business in Singapore, and also they got 2 clinics, which are the original company clinics that were in the IPO. The Hong Kong one is doing exceptionally well because there's a lot of medical tourists going into from China entering into Hong Kong. So they do very basic stuff like vaccination and so forth, and that is performing very well. And they're actually expanding the existing medical clinic in Hong Kong. The final part of the business is the strategic investments. As you know, they've got a 24% or 25% stake in Biolytics with a call option for another 10%. This company was listed in 2018. What this company does is they actually sell this particular machine, and what it does is it separates cancer cells using this fractionation or they say using pressure to try to separate between the healthy blood cells versus the cancer cells. So how they make money is not so much by selling this machine. What they make is actually the consumables that are loaded inside the machine, so that each test you maybe sell maybe $100+ US for the machine, because you need this one-off use consumables where the blood will enter into this device consumable, and this is where they separate out the cancer cells. The revenue is small right now because they've only rolled out this machine relatively new. But there are actually 2 key drivers, or 3 if you want, for the business. Firstly, the key one is their relationship with Sysmex. Sysmex is a huge $15 billion lab equipment producer out of Japan. So what it does is that they are working with Sysmex to actually roll out globally their clear cell FX system, this machine. So what happens is that because Sysmex wants to sell their cancer marker solution, so as a result, but to do that, they need Clearbridge, Biolytics product in order to separate the cancer cells with the usual normal healthy cells. So they need this as the front-end machine, then only they can do the analysis of the cancer drug. So this is quite a critical product for Sysmex. So the advantage for Biolytics is that they can actually tap on Sysmex global, as you know, this is a global lab equipment company, so they can actually tap on them. So the one driver will be working on and Sysmex starting to roll out their products globally and so forth. The other part is actually they're actually pushing and they're doing a lot of lab tests in China, and they will be actually generating some revenues out of China. And the third driver, of course, the eventual aim is you actually can get a Class 3 certification by the China's equivalent of FDA, but that will be maybe more of a 1 or even 2 years kind of time frame. So that's not so soon. But if you get that, then you can actually roll this out nationally. Okay, just to conclude, our investment thesis for this is just that they're actually expanding into very high growth markets in Indonesia and Philippines. Later we'll show both of these countries rank in terms of healthcare penetration. This ranks some of the lowest in Asia. And also, the attractive part is that they're creating a lot of recurrent revenues out of Indonesia, especially from the recent kidney dialysis and also the lab business. And they continue to look for profitable asset-like businesses, and they will actually not only just acquire them, but actually they will revitalize them. Okay, our valuation is based on the DCF of 28 cents. Just one last one, just to show you, the obvious, the attractiveness of the macro out of Indonesia and Philippines. As you can see, in terms of hospital beds penetration, Indonesia and Philippines is one of the lowest, even lower than Vietnam. In terms of the doctors availability, doctors per population, again, Indonesia and Philippines also rank very low compared to what's happening in the region. So it's a way to get into this very high growth healthcare businesses in Indonesia and Philippines. In Indonesia, I think there's only one listed lab company. This is the one here called Prodia. And in Philippines, there's actually no listed healthcare company. Healthcare centric. There are some, like maybe Avayala has some small business, but if you're looking for Philippines and Indonesia, there's very few such listed vehicles. Okay, and of course, healthcare spending in Philippines is growing maybe like 10% CAGR. This is just a chart on Singapore. I think everyone knows this. I think the problem for Singapore is that our old age dependency. If you look at this chart, we by 2030 actually we will probably be reaching kind of like what Japan is right now in terms of old age dependency, which is basically the number of old age to the number of working adults. And the other driver to healthcare in Singapore, of course, the life expectancy continues to rise. And this chart is from our US analysts, whereby as you age higher, the risk of cancer actually rises. So all this actually works in favor of Clearbridge lab business because they're focusing on the higher end kind of cancer marker oncology products. Okay, I will quickly run through this, our last slide. This is just our usual weekly update for Singapore. In terms of Singapore macro, there was finally some positive macro number coming for Singapore, which is the new orders PMI. After 6 months of decline, we did see some of our manufacturing new orders started to recover, albeit modestly, but this is off the 6 months decline pace. The other news, of course, we all knew or read is the data out of the US, which is the labor out of. But I think the one thing that you could be interpreted is that the payrolls are healthy, but the wage growth are softer. So actually, you could come back to this kind of Goldilocks scenario where there's less wage growth pressure on inflation, but at the background, economy is still growing steadily. And for China, as we highlighted before, due to the seasonality, we expect more positive macro coming out from China. I think obviously the big news was on the Genting news, but I think for us, I'm not going to run through that, but I think it'll be obviously positive for the construction sector in general, since you're going to have a 9 billion spent by both these IRs. In terms of our tactical view, probably this rally we think could extend further. I think what will help it again, obviously the progress made in the US and China trade talks, and President Trump has mentioned that the deal will be coming up in 4 weeks. So a deal could actually happen in early May. And then we still think that global growth will recover as we are getting monetary and fiscal stimulus out of US from the dovish Fed, and also out of China as they've been cutting VAT taxes and so forth, and income taxes. So all this we think, and also there's a huge approval of kind of a lot of their infrastructure projects. So we think all this will provide some uplift in global economies. And a couple of weeks ago we were worried about the yield curve inversion, but actually no longer inverted right now. So these are below just some final parts, some of the key events. Of course, we're going to get our Singapore first quarter GDP. We don't expect that number to be good. It's probably going to be quite a big first quarter GDP for Singapore. Okay, and that's it for us. If you have any questions, please post them. Thank you.
If there's no more questions, we'll end our morning webinar now. Thank you.